Because what I don't want people to do, and be careful about this, I don't think you're going to do this, but some people let the tax tail wag the dog.
Mm-hmm.
And you got to be careful with that.
Welcome to the Real Estate Mogul MD podcast. Thanks for tuning in and taking control of your financial future. This is a show where we not only motivate and inspire, we give you actionable real-world experience to help you live life by design. You'll hear journeys and stories from other physicians, investors, coaches, consultants, and entrepreneurs. And now, here's your host, Brett Riggins. Wonderful, wonderful conversation today. I'm excited about multifamily. I'm excited about underwriting. I'm excited about the benefits, whether they're tax benefits, income benefits. It's just an amazing asset class. And that's my opinion. If you share that, if you're going to share that opinion, you're going to love today's conversation. Today, we have a conversation with the founder and managing partner of KRI Partners and the KRI Group of companies. He has more than 24 years of significant real estate, banking, private equity transaction, and principal investing experience. Throughout his career, he has been involved in transactions valued at more than $2 billion, much of which he has been included in the acquisition, the management, and financing of these various multifamily real estate projects. Love it. I love the path going from a commercial lender experience into becoming a CPA, and now, man, just an amazing, amazing investor. And he's sharing that stuff with us today. Everybody, please welcome Ken Gee to the show. All right, here we go. Mr. Ken Gee, welcome to the show.
Thanks for having me.
And yes, I practiced that before we started recording, because just a note, it's always fun talking about stuff before the recording, but I always tell everybody, it's like, I want to pronounce the name the way that your mother says it, right? So Ken Gee, and I'm sure that you hear it all the time as Ken G.
And I hear Kenny G.
Kenny G, you got it. So if we break down into what the jazz clarinet, is that what he plays, the jazz clarinet? Then we might have a whole new show on our hands, huh?
We might, yeah. Although you wouldn't want to hear me do it.
Oh, goodness. Well, welcome. Again, appreciate your time, Ken. I'm excited to jump into it. And typically on the Real Estate Mogul MD, we have a lot of physicians on this show, but we are both not physicians, which is 100% perfect, because I tell everybody that you have to expand your association. I'm sure I'm not the only one that says this. I just regurgitate things that I learned and I find value in. So I put that back out there to expand your association, get outside your circles. And that's how we're going to learn more with each other. And us being both outside the medical practice circle, I want to tell the listeners just a little bit more about you. Could you let them in on what it is you do and what's your background?
Yeah, so I'll do the quick background, Cliff Notes version. I grew up in Toledo, Ohio, got my undergrad from the University of Toledo in finance. Then I moved to Cleveland, got my master's degree from Case Western Reserve. And while I was doing that, I spent 5 years as a commercial lender. And then when I graduated, got my master's degree, I decided it was time for me to be a CPA. So I went to work for Deloitte. If you don't know Deloitte, they're one of the big firms. Spent 7 years there. Really had a great time there, doing lots of M&A work and due diligence. And I was on the tax side, so I did a little bit of compliance in the beginning, but really got to do a lot of the really fun stuff, right? If you can consider anything associated with accounting fun, but it was. Excuse me. And it was there when I really got into real estate, because, I mean, if you think about it, accountants work really, really hard, right? So what happened was I was very, a lot younger than I am today, 25, 26 years ago. My kids were just born. My daughter was just born. And what happened to me is I was doing her 3 a.m. feeding. And if you're a father, with a daughter, that's a really cool time. And father-daughter bond is not something that you take lightly. It's really cool. Problem was 3:00 in the morning. That's my time with my daughter. And it just started to frustrate me. I said, this isn't cool. I mean, this is not what I wanted for my life, right? I did everything right. I had a great job working for the big firms. And so it was at that point I said, I got to fix this, because I don't want to miss my daughter's basketball games. I don't want to miss my son's baseball games. So I went headlong into real estate. Back then, I didn't have much in terms of ability to learn, right? There were no podcasts, there were no courses, nothing like that existed. Took me a year and a half to figure it out. During that time, I bought 3 buildings and sold them after 3 years, made $500,000. And I realized, wait a minute, I just made more money on the side in real estate than I did the whole time I was working at Deloitte at the time. I hadn't been there the full 7 years yet. So I just said, you know what, this is what I need to do. And fast forward, obviously I have been very, very successful. We have made millions and millions of dollars for us and our investors. And I'm happy to report I missed almost no basketball or baseball games. So we did the right thing.
Awesome. Well, congratulations. And what's very unique about that is that path. And I talk about it a lot on the show, is this unique stack of experiences that we have along our journey. And for you, sir, that path that you stacked up was very interesting, from finance, mergers, acquisitions in the accounting place, CPA. So you're basically learning the ins and outs of the language of business.
Yeah.
So then you pick that up and apply that to real estate. So I think it's great. And each investment is a business. And that's exactly what we're looking at, right?
I love that you said that, because so many people think real estate is passive, right? There's no business anywhere. That couldn't be more wrong.
Yep. And there are different avenues or exit strategies, investment strategies that we take to lead us a little more towards passive. And depending on how careless you may be with your money, it makes it more passive for you too. But yeah, there's no passive income. And each one of these opportunities is a business that we're running. And what a perfect alignment for you, Ken, and your journey of learning the ins and outs, speaking the language of business, which is profit and loss balance sheet, right?
Yeah, making money in any business is about the numbers, executing a business plan, all of that sort of stuff, and really paying attention to the details. So it is, when you're a CPA, you learn to do that. When you're a commercial lender, you tend to do that, right? So it just, not most people that get into my business didn't come from commercial lending and a CPA background, which gave me a huge advantage because I understood the business world a little differently than everybody else. The other thing I would say is, for me, real estate's not passive because I'm running the business, but we raise money and people invest with us all the time. They're passive. For them, they literally do nothing except, look online and see another deposit into their bank account. So there is the right way to become passive. It's just so many people approach this business thinking they can do what we do, and they view it for some reason as passive, and there's nothing passive about it.
Mm-hmm, mm-hmm. So interesting that commercial lending piece to CPA. That excites me, that path, because having the real estate background and stumbling on my path, and not that there weren't classes, but when we started, it was a little different. It wasn't the speed of data wasn't there yet. So the idea that path lines up, that's so cool. So commercial lending, tell us a little bit about how that helps you as a real estate investor.
Yeah. So obviously real estate's a capital intensive business, right? Requires a lot of capital, debt. You got to use debt wisely. You got to be smart about it. You can't abuse it. You got to understand how lenders think, right? Basically there's 2 people in every deal, a lender and the equity guy, right? Or gal. And so it really, really helps if the lender's going to be 65% of the deal, to understand them, really understand them, and what makes them think, why they need what they need, why they care about what they care about. And so spending 5 years as a commercial lender really, really helped. Now, oddly enough, I didn't really do much real estate lending when I was lending, but the concepts of lending are still the same, right? Your primary source of cash flow or repayment, your secondary, all that stuff still matters. And it just really gave me probably a very unique perspective on risk management, because eventually banks see deals go bad, right? Nobody thinks their deal is going to go bad when they go into it, but banks know, because that's just what happens. Not every deal makes it. And so how should you, how do you protect yourself against that? How do you mitigate that risk? So, it's just been massively helpful in helping me mitigate all the risks of operating our business every single day.
Mm-hmm. Tell us a little bit about that first deal.
Yeah, so it was a 28-unit apartment building in a area of Cleveland, Ohio called Shaker Square. So I as I told you, I started to figure out the business. I thought I wanted to do single family homes. I thought, I can't figure this out. Can't figure out how to make money. I don't know how to fix anything. There's no chance I could fix things. Then I thought, all right, well, let's go at the big end of the spectrum. Let's try to get 100 units. Well, wait a minute. My Rolodex at the time, there's no way I could get that done. I didn't know enough people with money. So I really got pushed into that 20 to 30 unit range, which at the time was very manageable. It allowed me to actually hire a person to be on site and work part-time to help me take care of leasing and scheduling maintenance and things like that. So what it was it allowed me, because I was still at the Deloitte at the time, working like a dog. I had to figure out how to do this and treat it as a business so that I didn't have to be the person to go show units and stuff like that. So that's how I landed at that size property. At the time I paid somebody a bunch of money to kind of be my mentor, but really what they did, they were somebody with a lot of experience, and they said, I think I see the numbers, I see what's going on. I think in 3 years you'll make $100,000. Well, they way undershot that, right? And I was glad for that. But that, that first deal, it's just really stressful because there's so many things you don't know. Whereas now, people doing their first deals now, they should be so much farther ahead just because the availability. My goodness, YouTube alone has so much information on it. And there's so many courses and programs out there that you can join to teach you some of the stuff that took me a lot longer to learn. I guarantee you that.
So as that first deal on a 20 to 30 unit, tell me a little bit about what it took to get the loan, because wasn't that lender looking for some experience? Yeah,
so back then the price was I know this deal really well. It was $575,000. Like, that's not a very big deal.
Right.
I borrowed $460,000, and I thought the same way you did, because I came from a commercial lending environment. I thought, if I had to pay back at the time a $460,000 mortgage, there's no way. It's just not. Why would a bank give me money? Like, are they crazy? Well, what happens in the real estate world is they don't look to the individual for the primary source of repayment. They look to the property. So they underwrite the property. You're just the last resort if something really goes bad. I had to personally guarantee it, and I would lose everything I had if the deal didn't go well. So yeah, I was pleasantly surprised that they will give you the money as long as the property can support the debt. And that's how it really works in the real estate world.
So even though you had no experience operating something like this, you were able to acquire the debt. And how long ago was this, Ken?
Back in 1997. It was a long time ago.
97. Yeah, I graduated high school in 98. Come on with
there you go.
Hey, man, and I still feel my age is relative, completely relative, right? And I'm now to this point, for the listeners, I'm holding up this little pair of glasses where when things, I hold them farther away from my face and I put these little things up here. So I'm there, but it's all relative. But that was a long time ago when it comes to markets, lending. A lot of stuff has happened in the real estate market and the money market since then. But typically, I guess it's a limiting belief that I have that I need operating experience on a multifamily before I can become or be the general partner.
Yeah. So you make some really, really good points there. So back in 1997, it's less than a $600,000 deal. And they looked at me as as the manager of the deal. He spent 5 years as a commercial lender. He's at Deloitte, right? He's got some business sense. So most people starting out at that level don't have a ton of experience. And so they knew the deal. They knew it would cash flow well. They just needed to be comfortable that I wouldn't screw it up. Now, what's happened, fast forward, remember, we went through 08, 09. I mean, lenders learned a lot of very serious lessons during that time. And every cycle, lending titans, they change their policies and their underwriting standards and so on. So it is harder now. But most people aren't trying to buy 28 unit, $575,000 deals now, right? They're more, that 28, you call it 30 times 100 to be more like 3 million, right? So now 3 million starts to matter a little bit more. And so when I say to people, you said this is a limiting belief you have, start off where it makes sense for you to start off. And that is, don't try to make your first deal 250 units. They're not going to give you the loan. You don't have any idea what you're doing yet. But if you start off in the 20, 30 unit range, they'll be like, okay, this makes sense. This guy is doing what makes sense to us. That's how you should start off. And then he'll prove himself, and then he'll go to the next deal, prove himself again. You see, and so you sort of grow up in the business. That's how you should do it. A lot of people try to leapfrog all the way up to that, 200 unit range. And even if they do find somebody in their GP pool that has experience, it really becomes challenging for them because they don't have an experience really. They've got a whole bunch of people in their GP pool. It just is kind of a train wreck waiting to happen in most cases. And that's why I want people just play in the space that makes sense for you, right? It doesn't make sense for your first deal to be 250 units, but it does make sense for it to be 20, 30, 40 units. That makes sense all day long, especially when you look at your resume and you're like, what, this guy's a sharp guy. He's a smart guy. He knows what he's got a good education. He's got, good job, whatever your situation is, whatever your resume is, they're banking on you to make good management decisions. And you don't have to have had 20 years of experience to buy a 30 unit building. You just don't.
Yep. Well, that makes me happy, and I'm ready, man. I am ready.
What's stopping you, man?
Yeah. What's stopping me? Focus. So we started in the single family world, and we've got some units, single family. We've got some mixed use commercial stuff in there. But I know after, especially this time of the year, when we're looking at end of year, looking at the P&Ls, looking at tax liability, where we're running our cost segregations to decrease our tax liability here. I know next year what I want to do for income, Ken, and that means that Brett needs to get an apartment building next year. So it is on, because I would much rather keep the money than pay it in taxes. And that the apartment building is going to be a big mechanism for that, because I am a real estate professional. That's all I do is real estate. So I'm excited about it. That's a great question. What is stopping me?
Yeah, I didn't mean to turn the tables on you, but so the one thing I want you to focus on, you didn't ask me this question, but I do want you to make sure that you nail underwriting. Nail underwriting. Make sure you understand the numbers, not just because I'm a CPA guy, right, and I'm a numbers guy, but multifamily money is made based on your ability to make that asset create more income than it did when you started, right? Because if it does, there's a pretty good chance somebody will pay you more for it, right?
Right.
And so what you'll learn is, if you know how to do the underwriting, really know how to do the underwriting, not this napkin stuff, not this 30,000 foot stuff, dive in, really understand the numbers and how the rents, where the rents are now, and can you legitimately make them go up, and understand how you can do that. If you nail that, you'll most likely nail your deal, because that's the number one thing that most people don't do. And they start off in the hole and they don't realize it because they didn't take the time to do that homework. But that's the number one thing. It's one of the things I love about multifamily is because it's not totally predictable, but it is fairly predictable that if I make the asset generate more cash, there's a pretty good chance that somebody's going to be willing to pay me for it, right? And that's the real money in real estate. It's not the little cash flow distributions you get. Those are baby. The big one is when that asset appreciates. If you think about, if you got a 100 unit property, and I know you're probably not going to start out at 100 units, but if you had a 100 unit property and you raise rents on average $100 a month, so that's what, 10,000 a month of new income. Most of that falls all the way to the bottom line, because just because you charge a guy $100 doesn't mean your whole expense structure changed, right? So there's 10 grand a month times 12 is 120 grand a month or a year. And you think, man, that's a lot of new cash, but that's not the real value. The real value is when you divide that by the cap rate, let's pretend they get 6 or 5%, you just created $2.4 million of value. That's the payday in this business. And that's why I want you to understand the numbers. Everybody has to understand the numbers so that you can make sure that you can generate that extra $100. Because if you do, you're going to make a killing.
You know what else that excites me about that, Ken, is the cost segregation on that, because that income is in the right bucket to where we could apply that cost seg, and then instead of recapturing it, investing it in another property, right?
Yeah, so cost segs, now we're going to get in the accounting world, but cost segs are tricky. You got to be careful with them. We do them as well, but all they're really doing is accelerating depreciation. And that's important and that's good. But what you have to manage is eventually, the tax man cometh, right? So you have to understand the longer term plan. Most people will say, well, I'll do a 1031 and never pay the tax. We've never actually done a 1031 exchange. I'm happy to pay 15, 20% tax. I'm cool with that because I'm going to take all that money and be even with the tax man and do it again. Now, that doesn't mean that my way is right. It's just how we approach it, right? That's what I would prefer. Because what I don't want people to do, and be careful about this, I don't think you're going to do this, but some people let the tax tail wag the dog. And you got to be careful with that because I see people all the time. See, the moment you come to a broker and say, I got 1031 money I need to deploy, you know what that broker's doing? He's literally drooling. He's like, oh my God, this is sweet. I got this guy right where I need him. Because he's had a deadline, he's got a deferred tax liability he's trying to prevent, and now there is a heightened chance that you'll overpay. So be super careful about that, because that's what I don't want to see people get into that trap, right? Just be super careful. Now, I would rather sell that asset, go into the next asset, do another cost seg to offset most of as much as I can of the income coming in. And if I don't get it all, I don't get it all. I'll live with that. So anyway, just some food for thought there on the tax issue, because taxes are expensive, but it's also right now, half of the regular rates. I like that. Yeah.
Yeah. And always looking at too, like what your income is this year, what you're projecting for it to be next year, because those rates affect you as well too. So lots of stuff in the CPA world, but I want to get back to this apartment building world. Let's talk a little bit about, I see that, correct me if I'm wrong, but I see that you're in the Ohio and Florida markets. Is that correct?
Yeah. So our company grew up originally for the first 10 years in Cleveland, and we did deals in Cleveland. We did well. But about 15 years ago, I said, man, what if we're doing well in Cleveland, but what if we actually went to a market where people really wanted to live? Just think of how much better we could do to be in a real growth market. So we went to Florida. We're no longer in any deals in Cleveland. We sold the last one before the pandemic. That gives you how long ago it was. And now everything we do is in Florida. And you know what? There is no way I can make the kind of money in Cleveland that we make in Florida, because it's an economics thing. When you have demand exceeding supply, I mean, it just puts upward pressure on price, on rents, right? Because there's not enough housing to go around. And then when we put our deliberate intentional value add strategy on top of that, we really do well. So we love Florida for that reason.
And in Florida, talk a little bit about how you're overcoming the insurance challenge there now.
Yeah, I mean, it's taken a bite out of things, no question about that. But so I'm going to go back to the business plan, right? When you underwrite and you decide whether or not you're going to buy a deal, you got to be really disciplined. And so that doesn't mean that I would do a deal that I think is only $50 a month in upside. I wouldn't do that. That's not enough money for me. I want $200 to $300 a month in upside that I know I can get, right? And the reason I do that is because I've just generated all this new cash flow. Well, what's the best way to protect yourself against inflation, more insurance costs, higher interest rates, whatever it is, more cash flow, right? So it's part of the reason that we're so disciplined to what type of deal we do. We just won't do those marginal deals. They have to be these hit them out of the park deals, because not every deal you're not going to get over the fence on every deal. And if it comes up short, I'm okay with a double, right? I just don't go for a single, because if I come up short on a single, well, it's not good, right? I don't like not good. I would rather have a double.
Mhm. So utilizing the cash flow and disciplined investment strategy to overcome the challenges in insurance in Florida. And what I'm speaking of, I don't know of directly, I'm just hearing it from speaking with investors in that area, are almost like a supply and demand issue. There's insurance providers who have left the state, have left the game.
Yes.
And I feel it's due to the natural disaster type scenario, weather type scenarios. Is that correct?
Yeah, there's a number of reasons insurers have left. Yeah, they had a series of hurricanes there. Insurance goes in cycles. I just, because I've been doing this 25, 26 years, I just know what happens. So right now, yes, insurers left the market, left the state for a couple of reasons. One was just the laws make it so easy to sue somebody else. And I mean, it's just that part of it's not very fun. And then there's this risk of hurricanes and things like that and some significant losses. And then they had some other law that allowed, if you had some roof damage, you could assign your claim to the roofer. And then the insurance companies had to deal with the roofer directly. And it just really got out of hand. So they're making changes to fix that. But here's what happens. Insurance price, yeah, it's been brutal. I mean, insurance rates have gone so high that these insurers now are just printing money because they raise their premiums and they raise deductibles. And that's a bummer for us, right? We'll get through it. But what happens now is they're making so much money, it will draw other insurers back into the market because it's just so ridiculously profitable. And the cycle will start to turn and pricing will come down. They call it capacity, right? There's just no place for some people to go to get insurance. That capacity will come back when, for example, we're just coming off of pretty low storm season. We just need a couple of those. These guys are recovering very, very quickly. And so I know that I believe we're pretty much at the top of the insurance crisis. And most of the people that we talk with in the insurance business believe that it's starting to turn, and it will. So if I could buy an asset now at this insurance cost, at this interest rate, and still cash flow, I'm in.
Yeah, it makes me excited about the in our single family world when we're looking at acquisitions on our high rates. I'm excited about that because if it works and it hits our investment criteria at this time, just think about what a refinance would look like. Holy smokes. I love it. And then on this $200 to $300, like per door per month increase in rent, which is direct to the bottom line of the cash flow, what types of improvements are you able to assume the risk for? Are you in heavy value add scenarios? Tell us a little bit about the types of properties that you like, Ken.
Yeah, so it's all of the above. First of all, we don't go below maybe a B minus C plus property. We just don't. So we don't play at the bottom, and we don't usually play at the very top. We play somewhere in the middle. So in terms of, I will tell you, there are some properties that they just didn't run them well. They did not maximize revenue. You go in, and simply just raise rents, right? You don't abuse people, right? You don't go in on day one and as soon as their lease renews, you jack them up $300. We don't do that. If they're $300 on the market, we'll move them half and half, right? We'll recover it over a couple of years because they can usually deal with that, right? And they know that you're trying to be fair, but we also can't leave all that money on the table. But when they move out and somebody new comes, we're going to re-rent it at that $300 if that's the number. Do we necessarily need to do massive improvements to the property? No, it just depends on the deal. So we've got one deal we did in Jacksonville. We spent almost $900,000 on, and we spent it. We love to start outside in, start on the outside, do the improvements to the amenities and the curb appeal and all the exteriors. You got to make them really nice so that people will then want to live there, right? That's where you start always on these deals. And then you go inside the units and just don't screw it up, right? Don't leave the interiors completely go. You just don't have to impress them with inside the unit. You just have to make sure that they don't leave because of it, right? Because the reason it matters, when you renovate the outside of a property, you're doing it one time. When you renovate inside a unit, you're doing it over and over and over and over, and it gets harder to control those costs. So that's the way, if we're going to renovate, that's what we typically do. But what we were really careful about is a couple of things. One, we don't spend money unless we knew it was going to be deferred maintenance. We don't spend money on things that aren't going to raise rents, right? We just don't, because it doesn't make sense. Our job here is to raise rents and make money for our investors. So that's the first thing that we do. The second thing that we do is the moment we close. So remember, I said we've done our rent survey, and we do a very thorough rent survey. If you saw our process, it's really thorough. The day we close, the next unit that we rent, we make it nice, and we do everything we can to get what we projected to be our market rents on that very next unit. And maybe we get it. Most of the time, we get pretty doggone close. So what that tells us, even if we have to come off that 300, let's pretend like it's a $300 increase. Let's say we get 275. Well, guess what? We just showed that we can get 275 out of 300 without doing anything. Mm-hmm. So then we'll try it again. Then we'll try it again. And we'll say, wait a minute. We're getting almost the way there without spending a dime. Does it make sense to do improvements? Well, now we're going to reevaluate our plan, because what do we need to spend this money? Or if we did spend the money, instead of 300, could it be 500? You see, gives us a new business plan to potentially work off of. So that's how we typically handle our value add deals when we take them over, because you would be shocked at how many times we get almost what we projected without doing anything. It's insane, especially when you're in a market like Florida where demand exceeds supply.
Tell me a little bit about when you're running projections in an underwriting scenario, building a model, and I'm talking about these rent increases, and say we're projecting, say, $200. How does that model reflect the reality of turns? You know what I mean? Like how does that model say, because I can't just go and then in 6 months, I'm going to raise all of the rents. No. I'm going to raise 96 units up $200. How does that model align with the reality?
Yeah, Brett, that's a really good question. So here's how we do it. We project our rents. We say, okay, our projections are always 5 years. So we then, our analyzer is very detailed. So let's say we have a 100-unit property and we want to have a $300 increase, right? So we know we're not going to go in and throw people out and renovate. We're just not going to do that. So we know that we'll probably conservatively do a third over a 3-year period. So a third in year 1, third in year 2, third in year 3. So now what will happen is on our renewals, we'll take back half of that $300. And some of those people move, but most won't, believe it or not, if you're in a good market. The rest of those people will get brand new people coming in at the $300. So what you see happening here is we think we're going to do it over a period of 3 years, but we end up usually doing it quite a bit faster, because some of those people know when you give them a renewal now in the second year and their total increase is $300, they're looking around at the competition. Well, you already know what they see because you did your rent survey. Mm-hmm. When I say you did your rent survey, you went in your car and you visited all the properties they would visit if they were thinking about leaving. And you know what the landscape is. And you're going to be like, no, I'm still the better value. Why would they move? Right? Unless they move way out of town. I mean, that you can't control. Okay. But that's how we do it. We generally, even through renovation periods, are able to maintain 90% plus, somewhere between 90 and 95% occupancy, even during renovation periods, because we do them as units turn. And we don't actively try to throw people out. I mean, these are people we're dealing with. So we want to make sure we treat them fairly. And, we explain to them, look, you're 300 under market. I don't want to do this to y'all in 1 year. I'm going to do half this year, half next, because, I can't, it's too much of a loss to keep going, but I also don't want to mistreat you. And they usually agree to it, but some of them, it just puts them out of their budget and they move on.
Yeah. That 90 to 95%, occupied thing is when I first started seeing that, I'm like, man, that feels really high, but that's across the board, and good, well operated buildings. That's what we're seeing. Can you tell us a little bit about the cost per door, cost per unit per year for insurance that you're seeing in Florida right now?
Yeah, we have properties that are at $1,100 a unit to $2,100 a unit.
Holy smokes, that's a lot. Holy cow. But it doesn't, whether it triggers a chemical emotion in my head or not, it doesn't matter. It's about what that spreadsheet says. So, wow, $1,100 to $2,100.
Just depend. Now, in Florida, it depends on how close you are to the coast,
Right.
how old the property is, what kind of construction it is. I mean, this isn't a random thing, right? If you're in the middle of the state with, newer product, I mean, you're going to be closer to $1,100-$1,200 a door.
Wow.
If you're, a mile and a half from the coast and your wood frame, well, I don't even know. That's probably going to be $3,000 a door. I don't know. I mean, that they just, they don't like playing roulette, just like you shouldn't.
Wow.
So if we have properties that are kind of close to the coast, but they're block construction. I mean, they're sturdy as the day is long.
Right. So can you contrast that for listeners on what a per unit annual insurance cost in Cleveland would have been?
I don't know, because I just don't know. I will tell you, because I haven't bought anything in Cleveland in so long, I would have no clue.
Mm-hmm.
But I will tell you that 4 years ago in Florida, $400 a unit.
That's why my mind went when you said 1,100, 2,100, because I was seeing, again, just having these conversations. I'm brand new at all of this stuff, but that range, because when we were looking at underwriting, understanding, hey, what number is reasonable for the insurance, and even to the point, Ken, where it's like, okay, this cost is projected per unit annually, right? But when we're looking at these, seeing 300 to 600. 300 to 500 kind of pocket, and then now up to 600 to 900 in those same areas. But, being on in Florida, that's crazy, but it's all perspective, man. Just like what we were talking about with age. We don't have to know everything, but these are the conversations, the information that we like to share, just to give you a little taste, plant the seed to ask the right questions.
Yeah. So one of the things, we have a huge investor education platform. And one of the things that I just constantly beat the drum on is, if you're going to get into this business, you need to have a good relationship with a good insurance person. Why? Because every deal we are going to buy, we have a conversation with them. You have to know exactly what's really going on. And you've got to dive in like that on everything: taxes, insurance, payroll. You got to understand it all, right? I mean, if you're going to get into business and you're going to ask someone else to give you money, you owe it to them to really dive in and do the necessary homework to make sure you know what's going on. And that's how you resolve that, because then guess what? If I'm buying an asset next year's, I got to deal with the same thing, right? So you're not uncompetitive, but you see, that's part of the reason that rental rates are higher in some parts of Florida, right? I mean, think about that. We're not going to operate these buildings at a loss, so rents have to go up to accommodate it. It's just, and everybody is in the same boat. It's not like you're the only person that has high insurance costs, right? You're not. Everybody else does too.
Tell us a little bit about the tax scenario. How does that work? How do you go down to the municipality? Do you have a conversation with them? Because if we're making multi-million-dollar investments and then we're leaning on somebody's opinion of what something may be, it's tough. Are you able to get tax projections in writing?
No. I mean, from any municipal authority, no, we never go to them for any of that stuff, because I don't know. First of all, you can't rely on it. It has no authority. So we, now we've been doing it for a really long time. So we know exactly what they do with taxes in Florida. If you're in Texas, you know exactly what they're going to do with taxes in Texas. I didn't mean to make that rhyme, but it kind of did. Wherever you're at, you just have to figure out what's going to happen in your state, in your county. That goes back to the homework, right? Doing the homework. So who do you call for that? Well, I talk to real estate tax professionals, people that do tax appeals all the time. Hey, tell me what's going to happen if I buy this property and it's $20 million. What's going to happen to the taxes? Well, they're going to do blah, blah, blah. Well, they'll tell you exactly, because it's not a secret. They do the same thing over and over again, right? So we know now. The people, you call up the county board and ask them, what are you going to do with this project? They're not going to tell you. These are CSRs. They're answering the phone. They're not equipped to have that kind of conversation with you, and nor should you ever rely on it. But you can rely on I would call one, then I would call another. And if I'm getting the same answer, there's probably a good chance that it's right. So that's how we model it out. Interesting.
Real estate tax professionals, are those attorneys or are those CPA, accountant?
Both. Yeah, both.
Interesting.
What you do is you go to the local apartment association and you say, like the Bay Area Apartment Association in Tampa, you say, hey, I'm buying this property. I need a tax person, a real estate tax person. Do you guys know anybody? They know everybody. Yeah, here, this one and this one and this one. They all join the associations. Why? So that you'll give their name out so that they'll get new business. And that's the way it works. But there's a really great source. You can also talk to real estate brokers in the market because they know who the stuff is, or property management companies also know who these people are.
Yep. Awesome. Well, I'm excited to get started on this. I really like that 20 to 30 unit range. And Good. Also, I'm also thinking my launch into being a GP, I kind of want it close to me. We do single families all over the United States, but something like this that's going to require that attention, I'm considering something a lot closer to me so I can put boots on the ground so I do know the market, a really important piece. But say I want to learn more, Ken, you mentioned a platform, and I'm guessing it's at the KRIpartners.com. Is that where? Yeah.
Yeah, okay. Yeah, it is. So our company is comprised of two components. One is people invest with us all the time. And we've got about 250, 300 investors. We've raised over $40 million and people are in our deals, right? And doing well. So that's KRIpartners.com/invest. If you just go to KRIpartners.com and you're one of those people who wants to learn the business, you just reach out to us because we have that investor education platform that is going to help people like you figure out, how do I underwrite multifamily deals? We've got a multifamily underwriting course that we're doing right now. I mean, it's been out. We teach students from beginning to end how to underwrite these deals. And then, we give you the course. It's all me, right? I'm walking you through every step. We give you the spreadsheets, everything you need. But way more important than that is we spend 6 months with you on a weekly call. Brett, you're going to go out and underwrite. And you're like, man, I don't understand this. Hey, Ken, I don't understand this on the call. Tell me what I should do. We get through the issue together, right? I'm there for 6 months. I think that's really valuable because in the end, right? Mm-hmm. You've got somebody who's been doing it for 25 years, making sure you're doing it right. That's valuable, right? At least I think it is.
Yeah.
So
yeah, absolutely.
you're going to see that I'm pretty passionate about investors making sure they make good investment decisions, right? Invest with experienced people as much as they can. And two, I want people to get into this business. I want them to do it right. Because you can make ridiculous amounts of money in this business, but you can lose ridiculous amounts too. Mm-hmm. You got to learn to do it the right way. So that's what we're in business to do on both sides. I didn't used to do the education piece, but now that I'm older and wiser, some people helped me in the beginning, and I want to give back and help people, even yourself, nail this stuff. Because I remember how stressful it was to do my first deal, not having that mentor, that advisor, that whatever you want to call it. It was really, really stressful. And there's no reason you have to go through that stress now.
Yep. And what about lead generation? Is that something that you guys talk about too?
When you say, we do a lot of things for lead generation. I mean, we're on Facebook, we're on YouTube, we're on Instagram, we're on podcasts. Okay. A lot of different ways. What usually happens in our world before our minimum's $100,000. So before someone's willing to, turn over $100,000, they want to get to know us. They'll come to our Real Deal webinars that we do. They'll watch a number of our videos. We'll have conversations. Sometimes they're in our education platform and they've gotten to know me through that process. It just depends. But what is important is that they take the time to build up the trust and a really good understanding of what makes that firm tick, or the person who's calling the shots. Make sure they understand how they think and they're very comfortable. This person knows what they're doing. So yeah, lead gen, it just comes from so many different places, but it's usually somebody has to see us or hear us or talk to us 6, 8, 9, 10 times.
Now, how about lead gen on the opportunity itself? So probably work with a lot of brokers. I mean, do you talk anything about off market? I'm talking about asset acquisition.
Oh, I apologize. Yeah. So you're talking about deal pipelines.
Because I get that asked all the time in this single family world. Hey, how do you find these deals? Hey, how do you get this? How do you do that?
Believe it or not, most of the deals that we find are through brokers. Mm-hmm. So we used to syndicate, right? So that's, you go find the deal, lock it up, and then go out and raise the money. Well, in a place like Florida, you're one of 20 syndicators bidding on the same deal, right? How do you differentiate yourself? So a few years ago, I said, you know what? We need to go raise the money first and then go find the deal. It's called a blind pool fund is what it's called. I don't want to get technical, but you're raising the money first. Well, we've done that. The last fund, we raised $16.5 million. The first deal never saw the market because brokers love buyers with money and sellers love buyers with money because their certainty of close is so much higher. And the second and third deal that we put in that fund never even saw the market. I'm sorry. No, that's not true. That we were the second in line. We were not the highest bidders on either of those two deals. And why do we get them? Because we already raised the money. We differentiated ourselves by raising the money first.
Nice.
So most of the time it's brokers.
Right.
And these brokers in these strong markets like Florida, man, it's hard to lead gen them, man. These are some of the hardest working people I have ever met in my life. They're incredible people.
That's awesome. That's awesome, man. Well, hey, Ken, I really appreciate your time. And for everybody out there listening, reach out to Ken, the education platform, the investment opportunities, everything can be found at kriproperties.com/invest for the investments, and the education platform is just there at kriproperties.com. I'm excited to learn more about it. Like I say, my passion is in it. Like it's there, it's happening. I removed these limiting beliefs. Next year, 2024 is the year for us to be launch into being a GP. So, well,
two things. One, it's kripartners.com/invest.
I show properties.
Yeah. It's wrong. It's kripartners.com/invest.
Oh, okay.
That's important. Number one. Yeah. And number two, you know what? Call me, man. When you're underwriting deals or you need help, I'll be happy to help you out.
Yes, sir. Awesome.
I want you to nail it. You got to nail it on your first deal. Because if you don't, you won't go back.
KRI Partners. KRIPARTNERS.com. We're going to put that in the description so you don't make a mistake like I did. And make sure that everybody can find that. And on Instagram, you can find Ken Gee there as well too. Ken Gee _KRI. Anywhere, I'll take you up on that, man. We're gonna keep rocking here, and I'm excited to launch. We've been looking at the education piece and learning a lot, and I'm ready to get after it, man. And thank you again for your time and everything you're doing to share your knowledge and experience with those who are also interested in making that, separating time from money and separating that, trading my time directly for money in the W-2 world, and clocking in, clocking out, and missing certain things in our life. So thank you for sharing all of that.
Well, thanks so much for having me. I really enjoyed it.
Awesome. Well, thanks again, Ken. And to the listeners out there today, thank you for your time. Hopefully you pulled some value out of this, and some of the to-do and not to-dos here is we're talking about multifamily investing and really scaling up in a direction and doing it wisely, taking those steps like Ken was saying, and surrounding ourselves with a power team, the people that we need to make these types of investments successful, not only from the acquisition, but through the projection and making those projected numbers the real numbers when it comes to the books, turning the pages and turning the profit. Thank you for your time and attention out there today. This is Real Estate Mogul MD.